Welcome back, everybody. This is the latest episode of our Minds of Market podcast, where we take a deep exploration into the minds of some of the best traders and investors in the market. And I'm bringing in this next guest who's actually a very dear friend of mine also. And the reason I'm bringing him in is because I get this question literally almost every single day in our trading rooms of what happens to my order when I send it out there? So with no further intro here, I'm bringing in my buddy David Mutnick. David is a managing director and the head of high touch trading at Dash Financial Technologies. They're a leading provider of trading solutions and software, and he leads a team that offers option brokerage to both institutional and retail clients, as well as floor execution for broker dealers down at the SIBO. Are you ready, man?
I am. It's good to be back with you. Just took me back about 30 years from when we first met, and I walked into the training class at Boda, and you started talking, and there was a lot of information coming at me back then, and I'm just glad I learned from you. I learned from the best. It served me well. Having those market making skills and days really has helped me as a broker to understand both sides of the business.
For sure.
Really helps me do a better job for my clients today, representing them and looking out for them.
And quite honestly, I'm glad it worked out for you because I never understood the brokerage side. All I knew from you and from one of your other mentors at Associated was 50 cents a contract, baby. 50 cents a contract.
What's an option worth?
Exactly. So can you explain first off, because we hear these terms all the time, what is the difference between an institutional and a retail client?
So a retail client could be anyone from me in my Fidelity account, or my neighbors on their E-Trade account, or a Chase or JP Morgan putting in a one lot, all the way up to a financial advisor representing either one high net worth client or a group of clients and putting in an order on behalf of all of them. That is the retail world. It is the retail strategies. It's people selling covered calls as income generation, buying puts to protect their position. The meat and potatoes of options trading coming from retail. Not to say they can't use some more advanced strategies, but it's coming from an individual looking out for themselves or an advisor looking out for his client and a group of clients.
Just like probably 99% of the people that are watching this are going to be on the retail side.
Yes. Institutional are hedge funds, insurance companies, endowments, family offices, and mutual funds, things like that. There's a lot of products out there at mutual fund companies that now use options for defined. Some of them are defined outcome mutual funds, things like that. Their clients are retail, but the order is institutional. It is coming in from a professional trader. It could be pension, just a few more pension funds. I think I said endowments, school endowments, charitable endowments, things like that.
So have they get treated differently as a professional? Is there any way that either you or SEC regulations or anything treats that order differently?
Well, I can't go. I can't speak to SEC regulation. I know that for maybe even some of your listeners and pattern day trading, where if you trade too much, that's a more of a retail concept. But I can't really speak to any of the the legalese or that kind of stuff. What I could say is if some guy or gal on their couch sends in a 500 lot spider order call spread, that is treated the exact same way as if the biggest hedge fund in the world sent in a 500 lot spider call spread order. It looks the same. It's probably treated the same. Now, institutional orders. Sometimes where it's a hedge fund, represent a hedge fund, the market making community on something that, and we'll get into it when it's being brokered, might look at it a little differently because of the information gap.
Which even back in the day, 25, 30 years ago on the floor, when a broker would come into the pit and we would ask, where's it coming from? We as market makers, we would definitely look at it differently.
Yeah, and for the market makers, they often see the same order over and over, or a client puts a position on and then rolls it over and over. They get comfort. They get certain comfort levels. Look, it's not like there's this evil world out there. It's that some people have information, or they're putting a position on that they have a high conviction that will be correct. They've done their research. They think a stock is extremely undervalued. They're buying calls because they think they're going from $1 to $9. Okay.
I'm so glad you just said that, because I think there is such a misconception out there, and I see it with my students that are trading with me. There is such a misconception that the people on the other side, whether they're the quote unquote market makers or the firms, that they have some, inside knowledge that, I better not trade with them, or they know something I don't. There is this, as you said, this like kind of predetermined thought of who's on the other side here. And I try and tell my clients that, when you're looking at trading on the screens and there's the market makers on the other side, they're not doing anything to try and make your order worse.
No, it's funny. Especially on the market making side, everyone thinks the market makers are out to get them, or they move their market and things like that. Most of the time, and we can get into exactly how the market works, a lot of those responses are due just to market structure. You post a bid and the offer goes up a little bit. Oh, they're on to me. They see me.
Supply and demand, right?
It's supply and demand, but also there's for lack of a better term, a whirlpool, okay, of information and orders. And maybe your order came in right as something else was trading in a related stock and some calls, and that made them go up. I can't tell you how many times I put a bid out and the offer has come down. Wait a minute. If I'm looking to buy them, why would they lower their offer? It's because they're responding, trying to attract you or be first at that price at an exchange, so that if you do step up, they get them versus a different market maker. So there's a lot of market structure things, and it gets pretty complicated. And it's a lot different than when you and I started. I think there's 16 exchanges now. When we started, there were four, I believe.
4 is us, New York, Philly, and on the P Coast.
Yeah, and all these exchanges have different models, right? Time, price, priority. So if you are the first person to put a bid or offer at that price and it trades there, if you're first, you get them all. Others are pro rata, depending on how many you put out there. If 10 people each put 10 market makers each put the same quote, but different sizes based on and a 10 lot comes in, someone might, and there's 10 market makers, someone might get 2 and someone might get 0 based on how many are showing. So there's all these different market structure forces that are in play as well, in addition to supply and demand. So circling back, it's not like these people are, there's this big evil conspiracy of the market makers. No,
people, the retail trader really has to understand that, right? They're not getting quote unquote ripped off. They're not, the people on the other side are not looking to not fulfill their obligation. It's after being on both sides here, and as you see it also, I can say that with 100% certainty.
Yeah, and the way I describe it to a lot of clients when they're asking why should they use a broker like me that sources liquidity and talks to the market makers, and I'm giving them information. I am telling them I am bid for a certain size that might move the market. And I have to explain how we manage that information leakage. But I always say this: they're not going to run away, because their job is to trade with you. If they don't trade, they don't make anything. Sure, they want to get that last, we'd say teeny, last penny.
Teeny, everybody, by the way, teeny stands for a 1/16th, which back in the day, we used to trade in fractions, not decimals.
6 1/4 cents.
There you go.
So, and so your listeners know, the fastest person on the floor of calculating spreads in fractions was Scott Bauer. No one faster than Scott.
Great thing I didn't have to go the decimal route.
So they're trying to, they want to make the most money, but they also need to trade. They want to trade. They want to be your partner, especially retail. Okay, because retail in their mind is deemed safer. Because the information that's out there for a retail trader is usually widely known. So they want to be your partner. They want you to trade. They want you to have a good experience. They want you to come back. They want you to roll your position. Okay. Every trade they make, theoretically, they're trading for edge, and theoretically, they're going to make something on every trade.
I would also think people use brokers, especially on maybe larger orders, for price discovery.
Yes.
So you don't have to buy an offer, sell a bid. You find out where the order flow is, and you get, a penny off of the offer or a penny better than the bid, whatever it might be. But price discovery is huge.
Yeah. And I do a lot of reading, and I participate in some discussions. Retail often looks at the bid-ask spread and just looks at that and says, I'm going to start in the middle and then work my way towards either the bid or the offer.
There's no question. That is 100% accurate. Yeah. That's what we do on a daily basis.
And there are plenty of times that is a absolutely right thing to do. But in today's market, okay, the way things are quoted, especially as you get down out of the top 50 names, out of the top 100 names into the more thinly traded names, where these markets are quoted.
Wider markets.
They're wider, but take a call that's deep in the money and really has no more. It's all the intrinsic value, right? It's a parity option.
Look at you! You learned that back 30 years ago. Intrinsic and extrinsic.
I learned that. Yeah, probably week one.
I know.
You take an option like that, where the stock itself is 10 cents wide, the option is $1 wide.
Yeah.
Okay, and let's just say again, without getting too far into put call parity, the puts are no bid a dime. Okay, so these things are going to be trading right around that. If you look at that dollar wide market and just start at the middle, you might be and you're buying them. Let's say you might be bidding well over where they'd actually trade them.
Sure,
because they're skewed high.
Yep.
The quote is the bid is good, parity right below parity, but the offer is just randomly high. Or the other way, the bid is 40 cents below parity.
Right. So it can easily be skewed one way or the other.
Right. So that's an extreme because we're talking about a parity option, which you could basically look at and have a good idea. But that applies to other options that are wide and in thinner names. Maybe it's a biotech that has an event coming, so the markets are super wide. Maybe it just doesn't trade and it trades 40,000 shares a day. So to do a 200 lot of a 50 delta option is a lot of deltas.
It's a lot of deltas.
Right. So if a retail investor just starts right there every time, there's going to be times where they're paying more than they should or they're selling it cheaper than. So how do you avoid that? Okay. How do you avoid that in an option that is not deep in the money? Okay. Let's say it's out of the money. Let's say it's a biotech that's a $30 biotech. It's the Jan 50 call that are $4, $6.
Right, because there's going to be some announcement at some point.
Who knows, right? Yep. Like those are the fun ones. But I don't know. I'm a broker. I don't know where they should trade. I don't know if they should be $5, $4, $6. I have no idea. So how do you know? How do you know? Now again, as a retailer, you could start somewhere and you'll see. They're 4.6. You bid 4.5. You get joined. Now they're 4.5, 6 with you. You bid 5 joint, and then you walk. Okay, so you could do that. What I do, because I'm also dealing in general bigger size, is now I start sourcing liquidity. And I don't know if that's a segue where you're ready for it, but what we do.
So the next thing I was going to ask you, and I think this goes right into it, and no, we didn't talk about this ahead of time, so this is great, was how does an order go from the client to either the trading floor or the electronic world or to your client who's going to take the other side of the original order?
Yeah. So there's a few ways. Okay. So I'll start with the institutional, right? So I have institutional clients myself. So those clients could do get an order to me today one of two ways. They could route me an order electronically from their desk, send me an order. Okay, they go on their computer and they send it to me. Okay, some of these clients, they just send it. Okay, they may follow up, they may not. It depends. They may be executing a strategy that I'm aware of. I know what to do. I get that order. It has a limit. I know what to do.
Question, sorry to interrupt. You're not picking up phones, right? Like in the old days, you'd be sitting on your desk.
No. So I was going to say the other way is they call up and say, "Hey, what's going on? Hey, how you doing?" We probably, talk for a minute or two, see what's going on, and then we get down to business. And hey, so I'm looking at XYZ, and I got these calls, and I think it's time to roll them out. Okay, great. What are you thinking? Okay, I have the July 12 calls. I'm thinking of rolling them out to October and go up a strike. Okay, but maybe they're short them. Okay, they've done a covered call strategy. I want to buy these back and then roll them out to the October 15s, up and out. Okay, very common strategy. Okay, and we'll look at the market together. Like, all right, I see it 110, 140. And what are you thinking? Let's see if we can start at 120 and let me know what you see. How many you got?
Bid, maybe the offer comes in 135.
Yeah, or I'll give some advice. Hey, there's a 2-lot there. That's a public bid or offer on a retail order sitting on the book. Okay, someone has put that there, making the spread look better, right? So there's a 2-lot bid on one of the sides that happens to be 40 cents higher, probably should get sold, but is sitting there. No one noticed it. And it's 40 cents higher than the rest of the bids, all the market maker bids. So I might say, look, it's showing 110 bid on the screen because these are 140 bid for 2. Yeah. The real market is probably like more of a 90 bid. Okay. I say, so, I'll start higher, but, maybe we should at least take a 110 low. You have that kind of discussion with the client, but they're in charge. Okay. I could just give them color.
Sure. But your color, though, is incredibly helpful, and that's what you get paid for.
That is what I'm here for.
Yeah, correct. That's the price discovery part of it.
Price discovery, I'm here to guide them and just give them the best information for them to make the decision, okay? I'm not calling them up and saying, this is high, this is low, you should sell, right? I am here to execute their orders in the most efficient manner, get them the best price and within their time frame, better than they could do it themselves. Because in today's day and age, every single client could execute themselves, up until the biggest hedge funds on the planet, the biggest banks could do it themselves on electronically themselves. So for me to use a broker, I have to add some value, and that's what
that ruined everything.
Right. Well, there's not as many brokers as there used to be. I like to say we're like travel agents, right? They're still around, but they're very specialized, right? You're not going to book a flight from New York to Chicago calling a travel agent anymore. You do that on AA.com, but you need a 7-city itinerary in Europe. You're going to call. So anyway, so that's how. So it is the phone, or I am, or and then I get to work. And look, just because I say I don't think 110 is the real price, doesn't mean I'm not going to try. Doesn't mean I'm not going to try better. So that's the way the institutional orders come. Okay. For your listeners, how do the retail orders get here? Okay. Retail orders, and I'm not going to use any names here, or any firm specific. Okay, to us, but retail orders. A lot of retail firms. There's two types of from 50,000 feet. The smallest orders, which I don't know what they consider the small orders. 10 lots, maybe 20, maybe 50. I don't know what the exact number is. Okay. Those orders often go on what's called a wheel. So you go onto your platform and you put in, let's just call it not a complex order, 50 calls to buy. Okay. With a limit, or market order limit. Okay. That order will go and first hit one of the market makers that are on this wheel. Okay, one of these firms that have contracted with the retail firms to fill those orders at or better than NBBO. Okay,
NBBO, National
Best Bid or Offer. Okay, so they are there providing a service. They are judged on how well they do. Okay, so that's the first step. Those smaller orders, and this is not exactly what I do. So part of this is me trying to understand it myself. On those small orders, if they don't just trade, so let's say a market maker responds at $1, okay, then the order is shipped to an exchange, because everything has to trade on an exchange. Okay, even if it's paired up beforehand, it has to go to exchange, and I believe it is then exposed to a second an auction for more price improvement. Okay, so that's how those smaller orders get into the system and where they execute. They are trading electronically. Okay,
they're trading electronically, and quite frankly, the retail customer who's putting the order in is getting a far better price than they would have 10, 20 years ago.
It is about it. I mean, I see it in my own personal accounts, and I see it every day. These things. First of all, the quotes are, when you and I quoted things. Can you imagine if someone said making a nickel wide? We'd be like, why are we even here? And these things are now a penny wide.
Exactly.
And even then, they get price improved at times too. They can't trade in tenths of a cent, but a 10 lot theoretically could trade 1 at one price, 9 at another, to give you a fractional better, right? So, the retail world has never been better. The amount of edge you're giving up at the table to trade is minuscule compared to what it used to be when things were in. First of all, even when they were in decimals, they were wider. So that's how that stuff gets traded. Let's just now you start going up the size scale, okay? 50 lot, 100 lot, 250, 500, 1,000. There's no reason a retail account can't do 1,000 lot in Spider, 2-point call spread in Spider.
Spider, Qs, there's a lot of
it's
markets out there where you get penny.
Not that, right? The relative risk to other trades and the capital required. Certainly retail clients can handle that kind of stuff. Those trades, again, depending on the brokerage, depending on your platform, might have an arrangement with one of those other firms to have those orders, quote unquote, kick out. They could kick out to the firm. Almost all of these firms have high touch trading desks of their own. So it can kick out to a firm's high touch desk for their trader to look at it.
And they're going to see it first?
They will see it first before it goes to the marketplace or any market maker. Okay, let's just say it's over any spread over 250 or any single list any, right? And or it could go to a brokerage partner, someone like me, okay? So what does that mean? So those orders, because of a certain size, and again, I don't know the arrangement and paperwork behind it between the client and the firm, but those orders kick out for manual handling for us to take a quick look at it and make sure the client is getting the best price. Because let's say a client puts in a Spider order, it's a little further dated, so a little wider. Let's say it's a Jan of this coming Jan of 25, 500, 525 call spread. I'm just making it up. I'm not even looking at prices. And that spread happens to be, I don't know, $25 spread out there, both in the money-ish.
Yeah, probably
70%. I don't know, $16 at $16.70. Again, just making things up.
They take 10 off.
Okay. 16 to 1670, and they bid 1660 for 1,000. The client, okay. If that purely went to the market, it would go to the market. It would probably bypass that wheel and literally go to the exchange auctions based on whatever that firm has, their routing relationships with other technology providers, whatever. It would go to one exchange, all exchange, whatever, and get auctioned at 1660. Yes, it's an auction. But I would be surprised if the price it traded would be the best price, as if somebody got in there, looked at it, and started calling people to provide liquidity or work it themselves. Okay, and
it's going to trade so quickly.
I mean, it's instant. I mean, it's literally nanoseconds. So those orders stop at those desks to look. And again, it could be something like we talked about earlier, where it's a parity option and they're sending it a market order to sell these things, right? And you don't want that affecting, trading 40 cents below parity because it hits the bid.
Unless you were on
those things might not be.
You were on the raise machine, retail automatic execution system.
The raise bandits.
Exactly.
Yep. Who would come in and arm us, but now you're getting into the weeds. But what I'm saying is that it's in some ways a way for the brokerages to not protect the clients. It's to do their job of best, execute this the best they can.
Due diligence. I mean,
so in some of those cases, they have deltas and things move while you're looking at it, and by the time they get to a lot of brokers like me, they are considered not held, where the firm might not held them. If they want to treat it, and this is again on the brokerage how they want to treat it, a held order, it does need to go, because you can only have it for like a second. It's held. It needs to be represented in the thing. If it gets to someone, if I have a not held order, I could do it. I could hold it, do my very best for execution, and it's not held. I'm not held to the screen. I am held to the limit. It's not like I have discretion over it.
Right.
But I'm not held. The screen is 50 cents a dollar. Someone says bid $1 on 1,000. I go, that's ridiculous. Like, I could put call parity. These should trade 75, maybe 80. I hold it. I could be wrong. Nobody wants to sell these things, and the stock moves, and I missed $1 offer. It's not ideal, but that's a not held order. That's most of the time, brokers do a really good job of filling those orders. So
and again, that kind of goes back to what we talked about with the evil empire, or the people on the other side trying to screw you, right? Brokers do a very diligent job, guys. I'm not going to say that somebody out there along the way maybe hasn't done something bending the rules, or something that could be construed as maybe illegal, but the majority, and I've been doing this for almost 35 years, the majority of brokers that I have dealt with, both on the floor, off the floor, the majority of the people that I have dealt with in entirety in this business, if you're not upstanding, if you don't care about your reputation, you're gone tomorrow. So they have to be. They have to be.
The thing, the funny business was more way back in the day, when there was no electronic exchanges, there was no CAT, which is Consolidated Audit Trail. There was and those brokers none of those people are still around.
No,
because the second a spotlight was shined on them, it was pretty clear how they had any sort of success, and they're all gone. And not only do we have a very robust compliance program, FINRA is very robust at this point. The SIBO itself, they do a really good job of keeping an eye on everybody, all the market participants. Okay, they do a really good job. But beyond that, there's pride. There's professional pride. I pride myself. Okay. Anytime I save the client money, look, there are brokers out there that might not be great. They might not break any rules, but that order comes in and they look at it quickly and they're like, I can't be wrong by by filling at the limit. I can't be wrong. Right. They bid this. This is the limit. I can't be wrong there. But they didn't do the very best. Right. Yeah. It's laziness. So we take enormous professional pride, in doing a really good job, knowing that if there's a trade that gets done, the market makers are still going to make money. They will not trade unless there's edge on the trade. I mean,
they've got it hedged off elsewhere. They've got their edge.
Exactly. Yep. But if I save some retail client $1,000, what does that mean to them and their family, right?
Yeah, you're a hero.
It's $1,000. Like you're a hero. To an $17 billion endowment. By the way, we treat those orders the exact same and squeeze it, and we don't look at it like, it's this rich endowment. We take our professional pride in those. It's like, see, that big an endowment, you're using me when you can use any broker on the street. Look at the job I did for you. It's the same pride, but we really, and I know it sounds self-serving to come on and talk about it and say, look how good we are. But you know me very well, and when we have our conversations,
that's why you're on.
Back in the day, and I learn from the best. I learn from the best traders, and you know who my mentor is in the brokerage side, and how he viewed everything, and what he instilled in us as our team, and we're all still together for the most part.
Yep.
And that professional pride and professional responsibility. So, but one last thing back to that, how those orders get there, because I gave on the retail side and institutional. So those orders that might not go to a broker on the floor and would go to an upstairs desk. I do know that there are some firms that you're able to call up their desk and ask for a quote and get and I believe that if you retail clients, some of them, depending on the platform, depending on the size of the account, can get those desks to help them figure out source liquidity or hey, I was out there bidding and I never got filled. I don't know why. Can you look into this? Not that they went offered and you're the screen's at $1 and you're bidding 105. How can I not be filled? But something much wider. We get requests for quotes from retail firms all the time. It's usually advisors. It's usually advisors in thin names. They look at a name. Every market is no bid at $5. Yeah. Nobody is streaming a real quote. It's one market maker is probably the appointed. I think they still call them VPMs, maybe specialists, but appointed. They have to stream something out there. If not, it's not an open series. But they have no interest in actually trading it. And it's in some of those types of names. We get requests for quotes all day long, and some of them, the client might have been hoping to pay $1. I'm like, they're at $4. Supply and demand, hedgeability, all these things go into. This is just not one that could trade. You have to. You're paying up if you want to do.
Which again goes back to liquidity, and it goes back to the efficiency of the markets. The more liquidity there is, the tighter the markets are going to be. The easier it's going to be to trade. The less the difference between the bid and the offer are going to be. Again, look at SPY, look at Triple Qs, any of the big names there. The markets are pennies wide, so there's plenty to trade out there.
Yeah.
And it's amazing to me that your side of the business, the brokerage side of the business, has, let's say, defied all odds in the face of electronic trading, and why you guys are still so critical to the efficiency of the market.
So I would say there's a couple of reasons why we were able to survive, and any broker that's still, and I'm specifically talking about people in my role, because there are, it's the similar business, but it's different upstairs broker dealers, and we can talk about what an upstairs broker dealer is versus someone like me. There's again a huge world of stocks out there that aren't traded regularly. I don't have the stats, but if someone looked up the stat, it's going to be some mind-blowing thing about how much volume is in those top 10 names. Apple, the Magnificent Seven, whatever it's called these days. Those names, SPY, Qs, versus even Philip Morris. I don't know. But these other names are big companies, but they're just not Dick's Sporting Goods. They just don't trade like that. Now so even a company like that, the spread might be 13 cents wide, 12 cents wide. And again, people are fighting for every penny for their clients. So you would call a broker to help you. Then there's fee mitigation, okay? Because in all these exchanges, from a retail, it's almost always all in or free, right? I think a lot of the retail brokers
provide liquidity and
free. Yeah. But there's this whole fee mitigation when you start going up the ladder of size, and if it's an account that's at a place that passes through the exchange fees. So some of them, like, they'll pay you if you do this, but you'll pay if you do that. So there's fee mitigation and all these things. I'll give you an example. So on a maker-taker exchange in a nickel class, I think one of the exchanges, it's $1 taker fee for you to buy any posted liquidity. Really? Okay, so if they're $80 and you just say, I'm not waiting around, I'm paying $1. You, per contract, pay an additional $1. Yep. Okay. But if that order came to me and someone said, I'm happy to pay $1. Let's not mess around. I don't want I risk missing these things. I appreciate you trying to do better. Bid $1. And I trade them at $1. There's no liquidity being taken off that screen. Boom. There's no fee there. There's no, now there might be a commission.
So many nuances to
so many different strategies and nuances and different exchanges and all that stuff. So brokers not only have to do a good job sourcing liquidity, price improvement. Okay, that's the two things that I, as a broker, those are my two things: source liquidity and then improve the price, of what is seen in the electronic lit market space, or improve the client's bid or offer. But also understanding cost mitigation, because money's fungible. I mean, they pay $1, pay a penny more on the option, but you gained $1 in rebates. I mean, there's all these different things, right? So we become experts in this. I mean, you remember the movie A Beautiful Mind and Russell Crowe? All these numbers. That's how I feel sometimes. Okay, that's how I feel. It's like, Scotty, when I was down there with you, I had a little tiny little mini computer and a pencil, and I was like, it was okay. I buy them here, I sell them here, and
we were carding our trades. And
you turn around and say, buy the stock. I'd sell it probably. Whoops, it's just a different world. And again, I think the investor has never had it better. Not just the retail investor, not just the institutional investor.
I couldn't agree more. From seeing what
they're getting prices that are insane compared to where they used to be. So the counterparties. So this is a good segue into institutional broker dealers and that kind of thing. Okay, so institutions often have they have a prime broker where their account is. Okay, so they might prime at one of the big banks or in that, the clearing firms. And they often will trade with that firm's trading desk, but they can go out to any broker dealer. Again, this is institutional paper, hedge funds, that kind, and shop their order. They can put out a request for quote to all the big banks, all those trading desks. I need an offer on 5,000 whatever. And those banks are in competition with each other to win that order.
Yeah.
Okay. And they want to win it for a few reasons. One, the commission. Two, hey, I'm the one filling you. Move your business here. Okay. I fill you 9 out of 10 times. So, and then up there, it might be a little different. Also trading for edge. Okay. And how little edge are they willing to do? Now, institutional broker dealers for institutional client, they often trade at fair value, knowing they're going to get the commission. Retail clients don't pay commission, right? So there wouldn't be someone really willing to trade for fair value against that.
It's a different strategy. It's a whole different model.
Different.
You never know what the other person on the other side is doing.
Yeah, right. But what I'm saying is those institutional client, that hedge fund or whatever, is now getting a price to me that is so much more competitive than it used to be, because not only do you have these 5 counterparties all competing for that business, you have the screens, the great equalizer. Guys, you're showing me $1. The screen's got 4,297 cents. What are we doing here? Okay, so you get the institutional clients. The retail client is in the best hands of ever, but it really, the whole system is awash in liquidity. When we started 1,000 lot, woo! Oh my God! So
monster.
AOL, I traded AOL, and that stock moved $4 a day. Okay, what does that Nvidia move a day, right? $4 a day, and I had gray hair at 24. Right. So 1,000 lot, a 5,000 lot. Oh my God! So now I get, hey, I need to do this spread 25,000 times. I'll pay attention, but it's not like I don't see that once a week. It's the entire industry, and you can look at OCC volume, how it's just gone. Yeah. Is awash in liquidity, and the more liquidity, the prices get tight. So you go back to those names that are super tight, Bank of America, even look at GameStop, how tight those markets are for a stock moving 80% a day.
Sure is.
It's because there's so much back and forth liquidity. Yes, I will improve you're coming in a market order. I could trade it here. No, I'm going to compete and sell that because I just bought the same option or the strike below it from the other guy, the other retail client that just is closing their call.
I just want to look real quickly at GameStop, markets here. And I'm going out a couple weeks at the money options, 15, 20 cents wide. That's nothing for volatility that stock is trading in.
nuts, right? Delta Airlines used to be 3/8 wide at the money back in the day. I mean, like, and the stock moved like 2 cents a day. Like,
Exactly.
it's just crazy to me. So, it's a great time to be an investor, and it's a great time to be an informed investor, because options are now mainstream, right? So, look, I know you brought me here. I'm amazed. I love what you've done, educating, what you've built, helping educate people to use other strategies other than just the basics, because there is real opportunity there, whether to hedge or generate income or to do whatever.
Yeah,
I think
trading options it's like Heinz 57. There's really almost an unlimited amount of strategies to accomplish the same thing, and you don't have to go about it the same way over and over. And I do this because this is how I traded on the floor, maybe even before people thought of trading that way. But I love it. And that's exactly what we teach people how to do. Dude, I can't thank you enough for this. This is so awesome because, again, you're the first person we've had from the other side. And everybody just always asks how, what happens to these orders, what happens behind the scenes. So this has been awesome. And I do want to get you back again.
I'd love to. I'd come back. I'll talk about what I'm seeing. We didn't get into trends.
Yep.
We didn't get into things that are trading now today that weren't trading even a year ago or 2 years ago. I'd love to come back. But the thing I want people to come away with is that they're in good hands. The platforms that your clients are going to be trading on are got really good at this.
Yep.
They have really good people, manning these options desks, and those people are. It's not. I'm not just me. Of course me, but not just me. They are using people. The people that are still in this business really did recently rise to the top. They are good people. They're informed people. They're there to help I don't know if that's the right word, but they're there. They're there to really ensure that these retail clients are getting the best experience. That's what I'll use. Experience.
I'm so glad, honestly, and I mentioned it before, I'm so glad that you're saying that, because I have this battle with people I interact with all the time that, they're facing the enemy on the other side, and that's just not the case.
Yeah, not the case. If an order's not getting filled what you think it should be, okay, it could be as simple as no one's paying attention.
Yeah.
Okay. It could be as simple as the auto quote that the computer-driven quotes are just not. They're set to be too wide and no humans watch it. It's not that someone's right. So anyway, I'd love to come back.
Next one though is going to be out on the green fairways.
Well, I got to learn from you again.
I don't know, but that's where we're going to take it up next.
Sounds great.
Listen, I really, really appreciate it, buddy. We go back a long way, and I can't tell you how much I appreciate your time today.
Awesome. Anytime.
Thanks, Dave.
Yep.
See ya.
Bye.
The Minds of Markets podcast is an exploration, a deep dive into the minds of some of the best traders and investors in the market. Our goal is to help you, the listener, learn from some of the best out there to improve your knowledge and skill set as a trader or investor. The Minds of Markets podcast should be used for information and entertainment purposes only. The opinions expressed in this podcast are our opinions only, and none of the information contained in this podcast constitutes a recommendation that any particular security, portfolio of security, transaction, or investment strategy is suitable for any specific person. Trading is risky, and past performance is not a guarantee of future results.